live with the Mortgage Geek on Smarter San Diego. No better place to be smarter than everyone else. Mortgage Geek.
Freeze frame.
Freeze frame.
Did I trick you?
Not really.
Every time.
You tried.
I don't know.
That time you didn't do great.
Whoops.
So, rising interest rates. I saw the rates go up today a little bit.
They did, yeah.
This has been a trend.
Absolutely.
Do you think it's going to continue?
Yes.
Okay.
Well, because they went up, right?
Yeah.
Then they kind of fluttered back down. Then they plateaued for a little bit. People kind of jumped back on, and now they're going back up again. It's good.
You think it's good?
Yeah.
Why is
I
it
want
good?
them to. Selfish reasons. Well, because I focus on purchase money transactions, and so does actually Cornerstone, right? We're like more about like book of business. We're not big into like consumer direct refinance, but like raising interest rates, like boom, raise them. Let's get everyone used to it. And then like in 2 years, let's kind of lower them back down again, and then bam, we got to refinance.
Yeah, that's true.
Refi boom.
Yeah, and we haven't had one of those really
No.
for a while. It's just been sort of a
Just been
steady,
kind of,
okay,
yeah.
but slowly declining, I would say. And now that rates are up, it's really kind of come to a grinding halt. The question is, will this rising interest rate environment cause real estate values to come in San Diego?
I don't think yet, and I don't know the actual numbers. You know the numbers this year, I think, or this month right now for actual active listings in San Diego County?
Active listings, I'm not sure. It's thousands though. It's more than you would think for
Yeah.
low inventory. I think the last time I checked was like 4,700.
I mean, but for 3.5 million people,
Yeah, when you put it in that perspective.
right? It's like, okay, well, even 6,500, I think it was last month or something like that. It's like, you know what's really funny, actually? I've been hearing like, hey, I have some listings. They're sitting there. I'm like, yeah, people just aren't overpaying.
They're done with that.
People are done with the overpaying because, you know, in 13, 14, 15, people were like, oh my gosh, 3%, these are never going to come back. You know, so that stuff is like really comical to me because it's like all of those people who had their threes now have fours because they refinanced.
Which is that's the trend though. I mean, it's like
Yeah.
people usually keep a mortgage for a short period of time. Because,
Under 60 months.
Yeah,
Yeah.
so less than 5 years is the average. So, if you don't think that it'll cause prices to go down, will they at least stay the same, or is there some sort of positive benefit we're going to see from an affordability standpoint with this?
I mean, that's a great question. I think that if you've noticed like more of like higher debt to income ratios, there's actually a really, really good article in the Wall Street Journal yesterday about how like the big banks aren't doing subprime, but the big banks are actually financing the subprime.
So they're not doing the subprime.
But they're financing the subprime because legitimately that's where the market's going again to create more products for people to afford more stuff. It's in yesterday's Wall Street Journal. So
How do they do that?
Wells Fargo right now has $75 billion that they've actually put into subprime. Now they're not doing it, but they're the ones financing.
So they're not underwriting it, but they're investing in it.
Correct.
They're providing the capital so you can go do it.
Exactly.
Or someone,
Yeah.
they're giving it to someone, right? Interesting. And so the reason they're doing that is because, there's just not enough traditional stuff, or they want to see growth.
Everyone always wants to see growth, right? Year over year. We need to make more, we need growth. Well, it comes to a certain point where it's like, okay, well, growth is going to come from being more creative, and we're getting more creative. I mean, look at Home Ready, Home Possible. Those are those conventional, you can go up to 97% financing, but all of your LLPAs, your loan level pricing adjustments, stop at 10% down, right? So like your max LLPA is like 150 basis points. It might have gone like over a lot of people's head, but anyway, it doesn't increase the rates all that much, right? And then the mortgage insurance is less. Well, it's allowing more people to get in at 97%.
So less money down. This is some of the same things that we saw before the bust last time, where subprime got aggressive and stuff like that. Have you been seeing? I mean, how's the market reacting to this? Are you seeing more products like that? Are people using them?
I mean, I'm not going after the 20% down, like $1 million purchase, $800,000 loan amounts. Hey, folks, don't send those deals to me. Don't send them to a direct bank either, because every institutional bank will smoke us, right? So it's like, let's focus on what I'm really good at. What I'm good at is like more of like the non-QM stuff, like, outside of the box, like 1 month bank statement, 12 month bank statement to create income, 1 year tax return. like those types of programs, like higher debt to income ratio loans. Like that's really kind of where direct mortgage banking, gets the advantage because, the big banks, no way they won't touch that. And it's good, fine. Hey, don't touch that, I'm going to. Because those people actually, I think, are a lot smarter of individuals rather than like, hey, I got my 20% down and I'm barely scraping by. Like these guys are like, hey, I'm using this money for over here because I'm going to create wealth by buying another business, and I'm going to shift it over here. Hey, I don't want to pay the IRS all this money. I'd rather invest that. So, hey, Sean, can you come up with a 12-month bank statement? It's better than, hey, pay Uncle Sam. Like, hey, put more money in my pocket through interest. Just joking.
And you've been known for being willing to go through any complicated deals, any amount of tax returns and things like that. You crunch through all that stuff.
Absolutely. I mean, I love tax returns. I know it sounds weird, but I actually I got a huge smile on my face if someone gives me a Schedule E that has 10 sets of tax returns, and I'm like, this is amazing. And people are like, you are odd, but that's okay. Because I understand how they all flow together, so it's really fun for me to figure it out. Maybe it's kind of like a pride thing going, I know how to do it, kind of thing. But
you'll get the deal done if it's possible.
Absolutely.
Which is what everyone wants.
This one of my clients, net worth $32 million, owns a bunch of Walgreens, gas stations, and stuff like that, right? Every single bank turned them down. They were like, yeah, we heard that you can. Everybody, they were like the biggest Debbie Downers. Like, I can guarantee you don't know how to do this. I know why. He showed negative $400,000, right, on his tax returns. Everyone's like, no way. I funded the mortgage.
Really?
Yeah. Yes, it was a lot of paperwork. I told them, I said, on day one, I can get your loan done after I reviewed this tax returns. But I said, you cannot hate me for how much paperwork I'm going to ask you. I will get your mortgage done, so you get to make a decision right now. Are you okay with me asking for as much paperwork as I'm going to? Do you really want this place? They said yes. Okay, cool. Let's get down to business here. I asked for all the bank statements. I created $700,000 positive on top of the negative 400 and was able to close on their $1.5 million purchase.
That's sick, dude. That is amazing. And that is why you are the mortgage geek right there. Because, and when we talk about the bigger banks and stuff like that in the mortgage space, they've always just been not really good at it. They do it, they're not great at it. They kind of halfway do it. They only want perfect stuff. They take a long time. They don't want those complicated deals. They just say, that's too hard for us.
We want the walk-ins.
Yeah, we want the simple stuff.
Yeah.
The easy, crispy, clean, the stuff that we don't need someone who knows mortgages, but they can process the paperwork and get
We
it
just
done.
want a rate. So if the guy I'm talking to on the other side of the table, right, the loan officer at a direct, at an institutional bank or credit union's like, hey, I can give you the lowest rate. Perfect. That's, to that certain clientele, that's all they care about. I can talk to them blue in the face to some people, like your underwriting's going to be horrible. You're going to close late. All these things are but they're an eighth lower in price. Okay, fine. You just, for some reason, the consumers are all about rate. Mm-hmm. And it's like blinders. They only know how to look at this number right there. And I'm like, gosh, there's so much more that involved, but that's where the institutional banks go after, right? So they're looking for that cookie cutter.
Yeah. Which
is fine. So that's why anyone in the direct mortgage banking space, stop going after those and then getting discouraged that you're losing escrows. I just told a loan officer that joined my team, Chris Brooks, amazing. 14 years. I'm like, hey, this is not our wheelhouse. Don't go up to an agent and say, hey, I want your $1 million buyer with 20% down. What? You're going to get discouraged. You're going to do the pre-approval. You're going to send it out. The day he walks into Chase to send off his earnest money deposit, he's going to smoke you. All that work goes down the drain.
So when we talk about, the institutions, which, there's a lot of things going on there, but with regard to technology, specifically mortgage technology. So we've seen a lot of the institutional banks or even some of the really what I would call corporate big mortgage banks have started saying things like they're investing in technology. We saw, Quicken came out with this Rocket Mortgage thing, which was a major dud from their expectational standpoint. That was supposed to be the technology.
It was.
But it turns out people actually want to talk to someone when it comes to something this big.
They're expecting 8%. They got 2%.
Yeah, that's massive getting crushed.
I mean, that is woo, crash and burn.
And 2% is a lot
Yeah.
from a market share standpoint, but when you're building out your pro formas on 8, that's a stinger.
Yeah.
So with regard to like the technology that's going, you've been investing in technology for Cornerstone for years, and a lot of people who've seen it and who've used it have said, this is cutting edge stuff. This is, amazing. You're ahead of some of the institutional banks. But now we're seeing some of those banks say, now we're going to invest, or we're about to invest in technology. Is there a chance they can catch up?
Absolutely not. I'm about to start, implementing technology. You are so far behind. I started my technology, the same technology that I use today, 3 years ago, and I'm still making tweaks to it. And I am tiny compared to a Chase, or tiny compared to, I'm not tiny, but these credit unions, or even some of my direct competitors in the direct mortgage space. Like, if they do not have technology today, the technology is going to be changing faster than they can implement the original. So they're gonna start, and they're gonna come out of the box, and they're gonna start implementing it, and then they're gonna design it. And by the time that they're ready to launch that out, technology has already changed twice, and they'll never be able to catch up. I'm telling you, if you are working at a mortgage bank right now that is not using the best technology right now, that all you have to do is make tweaks as you go along in the ever-changing world, you are behind, and I don't care how much money they have, they will not be able to implement it fast enough.
And when we say technology, let's be specific. What are we talking about? Because we're talking about loan officer technology, essentially.
Yeah, correct. The ease of doing a loan, mixing your service with technology, right? Okay, so if you come over to work at Cornerstone Bank, I wish you do. If you do over like $2 million, I am recruiting right now. Come over. I think that your life will change. But like, for me, right? So I'm running the operations, overseeing the bank, overseeing all the branches. And last year I did $134 million, number 63 on the Scotsman Guide. So how am I able to do that? With technology. So I input information here, and it autofills everywhere automatically, and it automatically sends emails from my email to the client, right? From my email. No borders, no balloons, no butterflies. Like, people are actually responding to my emails. I have like a chat, the chat feature within my document collection, like in my task section, that borrowers are using like nonstop. They're like, this is the coolest feature. They're literally talking to us while uploading the documentation just through the chat feature. It's all real live.
That's crazy. So the technology we're talking about is a technology that facilitates the communication between loan officer and buyer.
Correct.
Or borrower. Let's say borrower. So between the loan officer and the borrower, and allows you to collect documentation, but mostly communicate quickly and easily throughout the process. Is that what you'd say?
Yeah, correct. And everything is date and time stamped, right? So like at the very beginning, when someone does an online application, ours is not like a 1003 or a uniform loan application. It's just a series of questions that it starts going through. It's actually like a smart technology. So it's gonna, based upon your last answer, it's gonna ask the next question. So it's never gonna be asking for like documentation that doesn't exist. It's never going to ask you a question about your spouse when you didn't say that you're married. But on a normal application, it's like, hey, fill out your co-borrower's information. There's a red asterisk. Well, I don't have one. Okay, well, how do you get to the next page? It's so funny, like a normal uniform loan application, the technology, the old school stuff, it's like, hey, you can't see it until they've finished everything. Well, what if they have questions about like halfway through? I can't see what you're actually doing. Everything that they're doing is two-way visual with us.
Right, so you see what they're doing, they can see what you're doing.
They can stop. I can go in there and fill in the rest of it for them. So like, someone on the go with their kids and they're like, hey, I got this partially done. They hit save. I can call them on the cell phone, literally real time, pick it up and just finish the conversation as they're walking out the door. And I can fill out the rest of the application for them.
So it's not just a communication, then it's more of a connection.
Absolutely.
Essentially, you maintain a connection so that when you need documents, which happens, right? When you're processing loans, when you're in the middle of doing a mortgage for someone, you need stuff. You need to be able to communicate with the borrowers. We need to be able to do it effectively. In a busy world like what we have, this technology allows you to do that as efficiently as possible, essentially.
Well, correct. The loan officer's position is a lot more detailed than it ever has been before, and it's going to continue to get more detailed because there's more things that need to be done on a loan. There's more qualification, there's more like tweaks and everything that's happening. So the loan officer's job is getting busier.
Yeah. Yep.
But time never changes, right? You only have 8 hours. So I only have 8 hours, but now I have to do 15 tasks instead of 5 tasks. How am I going to offload some of those tasks where the borrower thinks that I'm, having communication without manually doing it? That's where we're going. And I'm telling, it does not matter about raising interest rates. Interest rate is only so much of a conversation unless you're going after like such a small market niche that you're going to get beat by institutional banks if you're going after that market anyway. That like high balance stuff, like, the small jumbos, like, I'm sorry. I just lost a client to One West, right? Because they offered him a 3.5% on a 7/1 ARM. Okay. That's lower than my raw pricing. I don't care. I would have to give 100% of the loan officer commission, 100% of the bank, and also pay 0.25% if I funded that loan. That's what they're offering. You guys, like that mortgage space, they won, you lose. I don't care.
Unless they screw up and they call you back, which I know happens a lot as well.
Correct. But those are the type of people. I want those little bit of hair on the deal. You know what I mean? And then that's where we're going to win. So again, pricing is not everything, right? Technology, and mixing like service, mixing, service and technology together is the future.
And products too, right? Because give us, tell us about a cool product or a cool loan that you've done recently, something that's non-QM or outside of the box maybe.
Well, I did one for Reef Point Capital. Was it Reef Point Capital? Reef Point, yeah. John Reeves is Asia. I mean, she's amazing. No one could touch this deal, and we literally funded the deal. So the gentleman, he's here from China. He's a student at SDSU. Has had a social security number for like 6 months. Like no history, never filed the U.S. tax return, owns 2 businesses, self-employed, 8 months, $1.8 million purchase, $900,000 down. Is he a foreign investor? Not really, because he has no income over in China. What is he here? We don't have any tax returns here, and we pulled out all the stops, and I funded that mortgage at $925,000. I was literally on the phone, like talking back and forth, like creating new guidelines as we went along to like make this. We use this as a real live example, and we're able to like tweak and kind of move and, hey, this document works better for this type to go, have the hedge fund securitize it. And at the end of the day, we kind of were able to bring to the market like a now really, really cool foreign investment stated loan. Bonkers.
Bonkers should be the name of the program.
Yeah, correct, right? So the next thing, what's so cool is like, oh my gosh, who is ever going to use this product, right? I'm not even lying. 2 days ago, Coastal Premier Properties emailed me and they're like, I have a client from China that's here, but they don't have any paperwork. They went to Bank of America. They don't even have an address here, but they want to buy a house with 50% down. I said, ta-da! I got a product, folks.
It's called Bonkers. That's wild. So you really helped create that product essentially with the hedge fund.
Yeah, I mean we were like on the phone, like trying to manipulate and trying to kind of fit it in the box where they could go and be secure, right? And we're not offering something that like to the client. The client's like so excited because he's like everybody else is like so, hey, you got to be inside of this box, and that's just not how society works.
Yeah.
It's like when they came out with, the government's program that they came out with, the HEART program. They're like, this is gonna change the world. Like, what? 3% or 5% of the people that fit inside of this box. It was like.
It was less than that.
It was like, cool. right? Like, oh my gosh, this is so amazing. Everyone's going to be able to get out, stop the modifications, refinance. It didn't work for anyone.
Nope. It was like less than 2%. I remember that very clearly,
Awful.
being on the radio during that time and having to help people and just not being able to explain why our government program didn't work for them.
Yeah.
Although their representatives were saying, we did this for you, this is for you, check on it. Didn't work.
Totally.
So when it comes to these products and your ability to get things done that can't get done elsewhere, do you think that that's a sign of anything? Do you think that that's a sign the market's too loose? Do you think that's a sign that we're approaching the top? Or do you think this is going to become the new norm now? And the first time we went through this, we just didn't know what the hell we were doing, and so we kind of fell on our face, and now there's a little more stability in what we're doing here.
We did fall on our face big time. It's never happened before, right? People have never missed mortgage payments on a large scale. People 228s with 3-year prepays. I mean, come on. We were doing 125% loans, right? Yeah. We were basing everything off of appreciation. So if you look at appreciation, you base everything off of appreciation. Well, then it really doesn't matter what the loan program is, because you're in the way that you're underwriting the loan is hey, I'm safe because the house is going to go up in value, right? Risk. Well, now we're not basing it off of that. So we have to qualify. We have to make sure it makes sense. Let's be honest, a $1.8 million deal, right? And the guy puts down $925,000. What are the chances of him actually foreclosing on that property? I mean, it's
he's going to do a lot not to foreclose on that.
Yeah, I mean, it's crazy, right?
I would write that loan.
All day.
I would do that
safe.
all day. I'll do that all day. Somebody has 30% down, I would write it. That makes sense.
Yeah, it does.
What's weird, and so what's strange is, a lot of the government products are all super low down, payments, which is fine. That's your bread and butter right there. You know, those are perfect borrowers for a mortgage banker. But when you talk about down payments, like that 20% person, that's not a good person for me. They can do better somewhere else. But this person here, who has a hairy situation, as you say, but has 40, 50% down, here's someone where you can find someone who has a brain that's going to say, you know what, that's a good deal. I want to make a deal out of that.
Absolutely.
And that's what you did.
And that's what we're doing, yeah, constantly. And so to kind of get away from just in the middle of the box, that's kind of boring, right? Let's put our brains at use. But I don't think that they're coming up with these new programs is hurting the market, because they're legit programs, right? It's not like we're doing this, hey, 100% financing, and we're going to start your income, and don't send us a bank statement, and go ask Bob and Betty over there for the down payment, but then you actually still owe them the money, right? So there are some checks and balances, and I think that they're doing the checks and balances in the right places, but also allowing you not to have to spend so much money on taxes in order to qualify for a product. You know what I mean?
Yeah, totally. I mean, what was interesting about the last run through when the products started getting crazy, the pay option arms and stuff like that, the thing that was crazy was they were clearly riskier products than the FHA loan, right?
Oh, yeah.
They were way riskier than that. And so things like what you're just talking about there, that half down deal at 1.8 million, that's a lot less risky. It doesn't fit into a box that's already out there. But you look at it, that kind of down payment, that's a lot less risky. I mean, when someone has that kind of skin in the game, they're going to fight tooth and nail not to lose equity on something like that. So there is more, it makes more sense. Back then what we were doing was they don't fit FHA, take them subprime.
Yes.
That's what it was. It was the next step down. And so with this, it's just hey, this doesn't fit in the box. This is a great deal. We just got to figure out how to make it happen.
Correct.
And that's a totally different scenario than what we were in last time. So I don't know. It depends on how crazy they get and how quick.
I know.
We got to keep our eyes on it.
We do. Don't bring everything on, and don't bring just I'm seeing them. I mean, what's really funny is people are repackaging other loans and everything like that. So it's so crazy. One investor actually sends out a product, and then they're allowing other companies to come and just take that exact product and change the name of their own company and then go out and go sell it at a higher rate. It's crazy what's actually happening. I'm like, why don't you just go to this guy? Your rate's like a 1% lower. But people just don't know how to see outside of the box, you know? But you got to be careful. You do still have to be careful. Like, we can't offer everything, but I feel that me still doing loans on what I consider to be a pretty mass level, right, allows me to really kind of see where the market is and what the temperament is, and to kind of bring in the products that are actually going to be useful, not just everything, right?
Well, let's go back to the change in interest rates. So rising interest rates. How do you feel the market reacted? Because it's changed. They started going up a little while back. So how do you feel like the market reacted to that?
I mean, everyone, the market is like, the consumers are like, oh my gosh, interest rates are so high. Like, I got a call and I just locked a 4.25% high balance VA loan. Like, I'm sorry, that's amazing,
That's
right?
amazing.
And then the actually guy called and goes, why is my rate so high? I was like, stopped, and I was like, okay, calm down, see what's going on here. And I was like, what are you matching it to? And he was like, well, 6 months ago, the rates are in the 3s. I'm like, oh, right. Interest rates are on the rise. The market, the consumers are like kind of freaked out by it. They don't know. People stop like refinancing unless they really are in desperate need of like cash out or doing something of that nature. But I think it's going to get normal. Just wait like 2 months. People, once they see like the 4s as a normal number, there's no real difference in like 4.25, 4.875 in the consumer's eyes in 6 months, because it's just a 4.
Yeah,
right?
True. So you feel like the reaction was a little knee jerk, but
Yeah.
it seemed like things slowed down initially. Like there was kind of a cold month or two in there.
Oh yeah.
Like a cold couple of months. But it seems to me that this maybe it's seasonal. I don't know, but it seems to me like things are kicking back up.
Yeah. No, I mean, our submissions, our underwriting and everything, I mean, we're hammered right now, which is great. So people are feeling more comfortable because they've been used to seeing that number, and it's going to even kind of mellow out even more, like more and more. So the interest rates went up like, really high, like almost 1% in like a month. So yeah, that's scary, right?
Yeah.
That's always. I don't know why they do that. They did that same thing in 2013. It's like,
It was bad that time.
why just stop the market? Do you guys not understand the psychological of a market? Like, why just slam that thing up to 4% or 4.5%? Why increase it 1%? Like, stop and go. Like the psychological part of it. Like, just keep creeping it up a little bit.
I think the bond market just gets, when the buyers go away, they all go away.
Yeah.
Because they're like sheep, right? Like the bond guys, they like all do the same thing.
That's true. Yeah.
So it's like one buyer's gone, and then they're like, oh, wait, what are we doing? Let's wait,
Retract.
And they get out. And then everybody's out, and then they sit back and they go, wait, that's a good deal again. Okay, yeah. And then they all come back in, and then it's like, okay. Or in this case, like they have started to come back in. But still, we're seeing there's clearly more paper there than buyers on the mortgage bond side. And that's where you're seeing interest rates creep up, which technically should be really good for the economy. I mean, if you have higher interest rates, that should be a good thing, or at least a sign that good things are happening.
Our economy's strong, if you look at kind of our currency, where we're at, like, is it as strong as we want it to be? No, but I think that we're pretty healthy right now, which is great. So raise those interest rates. Like, people need to get used to that. Like, an economy can't survive off of 3%. They just can't.
Yeah, I mean, you get yourself into the Japan situation where you just have like 3% forever, and then it's just a non-factor, and then you're basically at par with everything. It like never changes. It never affects the marketplace, which is not ideal. Ideally, you want to have that bullet in the magazine that you can,
in case anything happens,
that you can go to it. They don't have that anymore in Japan, so we want to make sure we have it, and you have to raise interest rates in order to do that. So for originators in technology, specifically, with institutions that say they're going to invest in technology, or they're in the process.
I'm telling you, walk. Open that door. Go see what else is out there. Truly, technology runs. And if they're not doing it already, if they're not even like halfway, even if they're like they've already started it, you're still behind. You should be actively using it. And if you're not, you're behind.
And what that means for you as an originator means you're probably doing too much legwork.
I have way too much legwork, way too much time, way too much everything. Like, who emails a list of documents and then, has the email of the documents sent back and then scrubs them and then resends out a new list? I mean,
that's time consuming.
That is very time consuming. And so our system is amazing because everything is date and time stamped. So no one can ever come back and say, why do you keep asking for this, right? So it's there. It sends out an email every single day on my behalf and asks them for the documents. And they get to see, like, down the line that they go. So it shows what they submitted, what they have left over and what they've submitted. And they just keep working down that line. And it emails them every day. Hey, just want to let you know, like, these are still remaining. These are still remaining. Do you need help? Do you need to work on those? Like, but we're not tracking. It's tracking itself.
And it's giving them a checklist essentially to work off of.
Exactly.
Yeah, that's huge. So with regard to overall marketplace, I know a couple months ago you said you were back in the market looking for deals. Have you been able to find any deals in this marketplace?
No.
So you haven't bought anything yet?
No. I mean, I closed on a restaurant. And operationally.
Do they own the real estate?
No. I wish. Actually, I wish on this one. I think that the market's still really good for investors. I think the value add stuff is still really a good direction to go, especially with ADUs. Call me if you know anything about ADUs, or if you want to know anything about ADUs. We're doing presentations for ADUs, accessory dwelling unit. The law passed in 2017 allowed a single family not to rezone to a duplex to add an accessory unit. There's lots of setback rules, and not every single property qualifies, but we're going around and teaching the community, hey guys, this is legit. Cash out refinance and build this other unit. You can build up to 1,200 square feet, 3-bedroom, 2-bath house on your actual lot, getting $2,000-$3,000 a month in rent. And it might cost you $100,000 to build that thing.
Yeah, there's crazy opportunities with those, and surprisingly, in a lot of the metro areas, it's green lit.
Yeah,
like North Park and places
North
like that.
Park's crazy.
Yeah, if you have the space, you can really value add your property.
I mean, turn your useless garage into an accessory unit. Cool. You can even have a detached where, North Park, a lot of the designs and everything are at 500 square feet. How cool would that be to have a 500 square foot unit in the back that maybe your kids go live in if they're older, or mom and dad want to live with you. 500 square feet.
VRBO, man.
Yeah.
It's a hotel.
Get some renters in there. So in LA, there's been over 1,000 permits pulled. Guess how many permits were pulled in San Diego for 2017 for ADUs?
I have no idea.
52. And I think my investors were half of them. I'm not even lying. Someone actually called me and was like, hey, I've been doing all this research. It looks like you're the only one doing the financing. And I was like, I'm going to continue. I think this is a gold mine.
I do too. I think it's where the real opportunity is in the San Diego real estate space right now.
Absolutely. I think it's incredible.
Tremendous stuff from the Mortgage Geek folks. The Mortgage Geek, Sean Cahan, joining us here on Smarter San Diego, guaranteeing to make you smarter than everyone else. Check him out, his Facebook page, Sean Cahan, the Mortgage Geek, to see some of the funniest videos that you will ever see, especially in this space. We'll see you again soon. Especially that one.